Good morning, everybody, and thank you for joining us today. Like every budget, this one came with plenty of headlines, sound bites, and a fair bit of debate. But beyond the noise, there are some very real implications for businesses, property lending, and personal finances. Over the next 30 minutes or so, we'll break down what's actually changed and what we might need to think about next. To that end, I'm delighted to be joined by Seb Burnside, our Chief Economist. Seb joined the bank in 2009 and has been our Chief Economist since 2018. Seb's team sets the economic assumptions used in our financial forecasting and scenario analysis, as well as interpreting how a changing economy and society can influence our strategy. His specific areas of interest include the economics of net zero and the impact of AI on society, and micro-analysis of customer behaviour. I'm also joined by John Neal, who is currently leading NatWest Group's Business Banking International team. He's got over 25 years of experience in business and commercial banking in a wide range of senior relationship banking, strategy, and operational roles. He's passionate about diversity, inclusion, and social mobility, and his remit sees us looking after over 1 million small businesses. John holds a law degree and lives in St Albans with his wife and children, and unfortunately is a Sunderland fan. So without further ado, I'm going to hand over to Seb, who's going to take us through some insights. Seb, over to you.
Thanks very much, Dave. Good morning and a really warm welcome to everyone. Thank you so much for taking time out of your day to join us for hopefully what you find a productive discussion, and just to re-emphasise opportunities to ask questions to tap away, and we'll address as many of those as we can at the end. So we're going to dive straight into it. I'm an economist. I'm contractually obliged to show you a chart of GDP at some point in this presentation. This is how we describe the performance of the UK economy over the course of the last 7 years in terms of GDP, the value of goods and services that we produce. Clearly, we're all familiar with the big fall that was COVID back in the 2020, 2021. But since then, it's been a kind of slow grind higher. There's been a few different gears we've gone through over the course of that period. Some flat sections where we've had to deal with really big things like energy price shock following Russia's invasion of Ukraine. But in general, growth has been pretty hard to come by for the UK economy. And that has been one of the key backdrops that led into this budget and all the fevered speculation around what policies may or may not emerge out of it. But I want to make one thing really clear at the outset, and that is that while at an aggregate level, it is true that we've seen comparatively little growth, that's not true. That's not a fair representation of actually the vast majority of the markets and sectors that our customers and businesses across the UK operate in. And that's really visible when you then break it down by sector, industry by industry. And in this table on the right-hand side, what I'm trying to show is the difference between where output is today versus where we were pre-pandemic, a nice clean comparison. And I think there's a couple of really clear stories coming out of here. Number one, there are some really impressive pockets of growth driving activity in the UK economy. Right up at the top there, technology, IT, clearly driving global stock markets at the moment, with NVIDIA and AI being a big part of what's behind increasing valuations. But it's not just a US story. Far from it. The UK has some fantastic businesses that are really helping the economy adapt and implement this new wave of technology into our day-to-day lives, and that's been a real source of growth over the last 5 or 6 years. Secondly, a real core competitive advantage the UK has had for many decades now, but increasingly so, is around professional services, and this can be everything from accounting, legal services, management consulting, all sorts of technical activities. And frankly, as the world is getting more complicated, as there are many more challenges to navigate. We are seeing more and more businesses need the services of the professions, and the UK's kind of core professional competencies being increasingly marketable overseas. So significant amount of export revenue actually derived from this sector. However, not everything can be a growth story. If you've got pockets of really strong activity, you are going to have areas of much more weakness. The two themes I'd call out on the lower than average side are really around first of all, exposure to consumer spending. So you can see towards the bottom of that table, hospitality, wholesale and retail, that's still operating below their pre-pandemic levels. And that's a story about how it has been a really tough time for the consumer through all these shocks and crises that we've been through. And of course, inflation has done a lot of damage to spending power. And then secondly, we've had themes, particularly in the manufacturing space, where businesses that are sensitive to energy costs have been at a structural disadvantage. We do have very high wholesale energy costs in the UK, and that has worked against many energy-intensive industries as they've gone on. So hopefully useful just to sort of level set where we are in growth terms, both at an aggregate level, which is modest 1% a year or so, and at a sector level, much greater level of divergence of stories between what's going on in the sectors in the UK economy. But behind growth is a really important issue, which determines, if you like, how much cash the Chancellor has to spend. And this is the fabled productivity story. Now, this was a huge feature in the pre-budget run-up of commentary, because as this chart tries to demonstrate, with the grey lines being successive forecast productivity growth in the UK by the OBR, we have been continually, if you like, disappointed by the outturns for productivity growth over the course of the last decade and a half in particular. We have seen the OBR Office of Budget Responsibility, the body which sets lots of the core assumptions that go to feed into the Chancellor's forecast. We have seen the OBR adjust its expectations, so it's not like this is an entirely new issue. This has happened before, but the purple line is a really significant downgrade in terms of the UK economy's ability to grow the output per person and per hour worked deep into the future of the forecast. And that matters because the way that this Chancellor has chosen to structure the fiscal rules mean that it all hinges on this 2029-30 fiscal year, where the day-to-day spending that the government makes is supposed to be covered by the taxation receipts. And a really core component of those taxation receipts is, of course, income tax. And the most significant factor in that calculation is the amount of value that workers are producing, combined with how much inflation is going on in the economy. And so the big story heading into this budget was that we would see a big downgrade to productivity growth, which we saw, reducing the amount of money that the Chancellor has to spend in the final year forecast. But actually, the surprising component was we saw an increase in the inflation assumption about how much growth would then turn into particularly nominal wages and therefore tax receipts. So it wasn't all bad news that the OBR delivered to the Chancellor. Instead of a kind of 30 billion black hole that many were expecting, we saw, depending exactly how you cut it, numbers more tuned to the kind of 8 to 10 impact on the government's finances. So a kind of worse economic picture than the Chancellor had back in the budget in the spring of this year. Fiscal statement, I should say, not rather budget, but not as materially worse as actually the vast majority of external commentators had expected. We now come to effectively the choices that the Chancellor made in how to respond to that changing economic backdrop. And the choice when you have a gap between tax revenue and spending presented on the left here as a share of GDP, all governments face a choice about how to close that gap, given that fiscal rules require it to be closed. You can close it by doing austerity and reducing the share of spending as a share of GDP. That was the choice that was made from particularly 2010 through to the late, through most of that decade that followed in the Conservative government, the coalition era. Or you can choose to try and raise more tax revenue to meet the current level of spending as a share of the economy. And as we try and show as clearly as we can, across quite a long history on the left-hand side, this government's made a very clear choice that taxes as, well, let's start with spending actually, spending as a share of GDP is going to stay pretty constant. So from a figure of about 44% of GDP today to 44.3% in the final year of forecast. That's a relatively flat but very elevated level of government spending as a share of GDP compared to any of our history. Only really in the previous kind of peaks of crises have we approached that kind of share of government share of economic activity. And the gap is being closed overwhelmingly by having tax revenue increase from roughly 39% of GDP where we are today up to 42.4% in the last year of the forecast. That's a really big policy choice, and it is a reflection of this government's priorities and where they think the right balance of priorities, political objectives, and fairness lie. But there's no getting away from it. We are closing. The plan is to close this fiscal gap by putting taxes up as a share of economic activity, and that's to a level which, frankly, is unprecedented in kind of modern economic history of the UK. There aren't too many graphs I can draw you back to the 1940s with UK data and show that this is this is a new high. Well, tax revenue as a share of GDP forecast, that is absolutely one of them. So a really big change in the shape of the UK economic activity as planned coming out of this budget. Now, a really a sensible follow-on question from that observation, we're reaching a new high of tax revenue as a share of activity, is where does that put us internationally? Historically, we have been more highly taxed than kind of North American economies, but less highly taxed than stereotypical kind of European economies. Where does it go from there? Well, chart on my right-hand side attempts to show you that kind of split. And effectively, we're moving from where we are today with this chart and where we are significantly above the US in terms of taxation, but substantially, I would say, lower than Italy and Germany, and certainly France, in terms of share of tax in the economy. We will be drifting further up that table, but we will still, even reaching a new high for the UK, we will not be at levels which Central Europe is seeing today. And actually, those governments would probably have rising shares of taxation as a share of their own activity in Europe too. So it's a really big change for the UK, but it probably is a smaller change when you think about the UK compared to the position of other countries. So something which we think is quite a helpful distinction to sort of draw out from what is otherwise quite a big scary headline, the idea that taxes are going to reach a new high. So really significant choice number one from the Chancellor. We're closing the deficit by putting taxes up. How we're doing that though is has quite an interesting shape to it, and I think this matters, one, for the kind of the economic policy aspects, but also two, for thinking about how the effects of those choices feed through into the market and into the customer bases that ultimately, in particular, business the UK serve. So what are we trying to say here? Well, this was a contractionary budget, right? So we have put up taxes by more than we have planned to increase spending. You can see that in the outcome of the headroom increasing against the Chancellor's fiscal rules to now roughly 22 billion. So we get therefore, in this first chart, we get a purple line to denote this was a modestly contractionary budget. And therefore that is sort of, effectively in demand terms, weighing on growth potential and activity in the economy. That's true when you look at the whole 5 years added together with the forecast. But this budget has a very unusual feature relative to other budgets which have been contraction in the past. And that's what we're trying to tell you on the right-hand side of this chart. Because you might think that if you were trying to close the deficit over the course of 5 years, you might try and do a little bit each year to reduce that gap, and therefore to kind of make the impact in any one year somewhat blunted. That could be quite a sensible strategy. That's not the choice that this Chancellor has made. Instead, the year one and year two impact of these sets of policies are actually expansionary. We are spending more in the short term, and we're taxing back the proceeds much more backdated, much more loaded into the later years of the forecast. What policies are we doing that with? We'll come to some of the specifics in a minute, but the big ones that cost money, the releasing of the two-child cap on benefits is a big feature of that, and the support for household energy bills also cost the government money in the near term too. Those are areas where we're going to see more spending with relatively little early action in terms of raising tax revenue relative to the announcements that were already made in previous budgets. So, a contractionary budget, yes, but one that for the economic kind of modelers and the thinking about where the demand kind of washes out, we might see people feeling a little bit more cash in their pockets on a really day-to-day basis, theoretically, in the very early years of this forecast, even if they remain very cognizant of the tax rises, largely through increases in, freezings of personal allowance that are coming later on in the forecast. So quite a complicated sort of shape to the decisions that the Chancellor's made there. These are small, but I think significant differences to think about year on year, and it also speaks a little bit to this issue of credibility, which I'll touch on later too. It's helpful that the Chancellor has improved the credibility of the plan by widening the amount of headroom against the fiscal rules that she has. But in terms of how you go about doing that, promising to do difficult things later on into the future against the political backdrop that any country finds itself in at the moment is less credible than the commitments that are made on increasing spending in the here now. I think that's a fair point to raise at this stage, thinking about that shape and that trajectory. So those are the key points I want to land on the overall shape of what's happening in this budget. We've got taxes going up to new highs, albeit it doesn't change our relative position in the kind of rest of the world with tax as a share of GDP. And we've got this curious kind of shape to the budget decisions of more spending in the near term and the promise of more taxes later into the future. And I think that will affect how different people and different stakeholders sort of view their experience of the budget. But let's dive into some specifics. What does all this mean for inflation, first of all? Now, inflation is a super important feature of the economic landscape. We are all quite scarred, I think, from the fact that we saw consumer price inflation go up to 11% in early 2023, aftermath of Russia's invasion of Ukraine and the energy price spikes that I talked about as post that. Now, we have had inflation come back down. It briefly hit 2% about a year ago, before tipping back up to just below 4% in autumn of this year. And we now believe that we are sort of past that second peak, if you like, and we're headed down towards a more sort of 2%-ish Bank of England target. What this budget means for headline CPI inflation, I think, is relatively directly the impacts of removing largely kind of renewable subsidies from consumers' energy bills directly and funding them from general taxation instead, will have a kind of mechanical reduction of inflation when that kicks in April next year. And secondly, the somewhat time limited but policy on fuel price duty as well will help move prices in a similar direction in the short term. So we've had a couple of elements that should help to reduce consumer price inflation in the near term, paving the way, we believe, for Bank of England to cut interest rates at its next meeting, which is on Thursday next week, if my memory serves me rightly. Always a finely balanced decision committee that has very independent members voting in very different ways recently, but so far we believe the data and the markets expect that to be the outcome. We'll have to see if that holds true on the day itself, the 18th, I believe. But impact number one on this budget, we do expect near-term falls in inflation to be a bit faster as a result of the policies that the Chancellor announced. Another big impact will be obviously on the housing market. So a very novel policy that we've had announced at the budget was the kind of colloquially branded mansion tax. I think its formal name is the council tax surcharge of some form or another. And this is going to capture in England houses that are worth more than £2 million and various bands beyond there as well, with an additional annualized charge. Now, there's clearly a lot of operational detail to be worked through there. We don't yet know, other than that there will be some sort of attempt to revalue properties that are likely to be caught by that band. So we'll have to find out exactly how that works when the relevant elements of government report on how it's going to operate. But in terms of how the market reacts to it, I think it's fairly clear that we've got a strong sense of direction there. And that is that the way this tax will operate is effectively by increasing the cost of ownership of properties above those particular price points. And if you were to apply kind of pure economic theory to this, what would happen is you, because of that increased cost of ownership, you have at a stroke sort of reduced potential buyers' willingness to pay for those properties by an amount which is effectively a kind of discounted cash flow of the stream of future values of those taxes. Now, two comments to make at this point. One, reality doesn't work quite as cleanly as a discounted cash flow does in theory. And two, there is a level of uncertainty about the way this operates, if, how, when it will get brought in, whether subsequent chancellors may increase or decrease that kind of relative charge or change the bands, etc. So plenty of uncertainty sort of running around the estimates. But I think we've got good evidence from previous policies to show that we would expect buyers to reduce the amount that they are prepared to pay, prepared to bid for higher value properties across the UK, particularly focused in London and South East for obvious reasons that that's where really high concentration of high value properties are, but plenty of other places, particularly in England with smattering of properties in those values. What we would also observe is that buyers tend to get there a bit faster than sellers. So if you have a property going on the market already, or if you're thinking about putting a property on, you know, whether surveyors, your advisors, or homeowners are themselves prepared to fully adjust instantaneously to that reduction in appetite for those properties, you know, we tend to think that it takes longer for that side to adjust. And so in the short term, you have this gap open up where, you know, buyers are prepared to pay quite what they were before to make the market clear and get transactions going. Sellers take longer to reduce their price expectations. And therefore, in the interim 12 to 18 months, you would have fewer transactions. You'd have a bit worse liquidity in the market as prices started to drift down on their adjustment channel. And final point to say is that this, of course, comes off the back of tightening in the non-dom or abolition of non-dom sort of tax status, which we believe has had quite a material impact on the top-end housing markets in London and the South East, and that impact has trickled through probably a bit further down, frankly, the price spectrum than even we'd expected that to have. Such that if you look at house price growth across all areas of the UK today, the only region, according to the official statistics, that is down on a price basis year over year is London. Every other region is seeing some level of growth. Only London is in absolute negative territory because it's the high value properties in London which are most affected by this. So, long story short, mansion tax won't affect very many people directly, but may actually have a bigger than anticipated impact on the market, but one which is very skewed by where the properties are in the kind of relative valuation terms on that. Third area I just wanted to dive into on the budget impacts for specific markets is the jobs market. So a quick check-in first on what's happened in the last 12 months since obviously the really big shock of increasing national insurance contributions for employers announced at the last budget 12 months ago. We have seen quite a lot of job shedding, particularly in retail, especially in hospitality, but also across care and a number of other sectors that are big employers of people earning relatively close to living wage earnings. There was no similar shock in this budget, but we did have the new rates for national living wage and national minimum wage announced. Somewhat smaller than last year, but still significant, 4.5% on the living wage, and the 18 to 20-year-old figure catching up even further, up to over 8% from memory. And yeah, thinking especially about the higher proportion of young workers in that segment that are employed in those sectors of retail and hospitality who are most struggling in employment terms, and running into this, we do think this will further dampen demand for workers and opportunities out there. The good news is that we think the employers have largely adjusted to the previous changes. We've had about 3 months where vacancies had been falling since their peak in sort of 2022. So that was a good indicator of the labour market slowing and cooling. They had levelled off, which was encouraging. We may see a little bit more levelling before they do start ticking up, hopefully. As businesses feel a bit more confident to employ staff after this point. And who knows, but it's plausible that actually the changes to the Employment Rights Bill, in particular, the removal of effectively instantaneous full rights against things like unfair dismissal from day one being pushed out to 6 months, that could have quite an important impact in terms of helping businesses take a bit of a risk on employing people rather than immediately being trapped in positions they might not want to be in as a result of that. So impact on employment, much smaller than last year, but we're still in a market that is just about getting over the hangover from the national insurance increases. Whilst we did see changes, in particular to a very technical area of national insurance contributions on salary sacrifice schemes, that is not scheduled for implementation until 2029. So whilst it does raise a fairly considerable amount of money, and it will be significant for employers, I think we're going to put that in the kind of too far away to factor into today's plans. Businesses and their administrators and advisors have a long time to work out what the right way of approaching that is. So I think we can park that particular impact for this budget at least. So impacts of the budget across our three chosen markets. Inflation down a little bit in the near term. A significant weight added to the top of the housing market, I would suggest, and some potential indigestion for the labour market around young workers, but a much lower impact than we saw at the last budget. In terms of what this means for people across the full suite of the budget's measures, and this is taking the full 5-year view. This is the Treasury's own distribution analysis of who wins and loses. And the first thing I'm going to ask you to do is to ignore the light pink shading at the top, and therefore the average bars, and focus instead on the bits that people definitely feel, which is the tax they pay and the welfare benefits that they receive. Which is the almost red and the medium pink. There you can see a clear trend where everyone's taxes are going up. Doesn't matter where you are on the distribution, actually. Everyone's going to be paying more tax on average across each of the income deciles. So poorest, lowest income on the left-hand side, and most affluent, highest income on the right-hand side. But for those households in the bottom 3 deciles, so the poorest 30% of the population, those increases in taxes are more than offset by increases in benefits of welfare recipients, principally the two-child cap on benefits being lifted there. Everyone else will end up with less money in their pocket directly as a result of this budget. And in that sense, it's a relatively sort of clean, predictable, and simple budget in that sense. Clearly, with the child factor, there are some nuances there. So there are very meaningful increases for larger families who are in receipt of those benefits. Less impactful if you're poor, in a childless family, for example. So some nuances around that, but at an overall distribution level, a relatively simple simple impact of the of putting taxes up in order to close the deficit there, making most people worse off. How did this land with everyone and all the constituencies, and what are the reactions? Well, first of all, let's start off with the markets. They largely reacted with a kind of either a neutral to a cautious welcoming a response, depending on exactly which time period you're looking at for the reaction of the gilt market. Gilt yields were somewhat lower in the days following the budget than they were before. And I think that's a function of two things. One, there is greater headroom, at 22 billion versus the 10 billion that was in there previously, giving a little more confidence of meeting the targets that the government set out. But as I mentioned earlier, that is tempered by meeting those targets in a less credible way than other options, for example, by putting tax up today. So that was helpful, but not earth-shattering. Second factor, actually we mentioned earlier, if we've got lower inflation and more confidence over that in the near term, that should give the Bank of England more space to cut interest rates, and that has a very direct impact on the gilt market. So that could well be quite a substantial portion of the market's impact to that. But certainly no adverse reaction to reports, which is clearly very helpful to government and very significant for anyone operating in and around those markets. That's what the market thought about it. What about the public? Well, I have to say the British public is a very cruel constituency to this current crop of politicians, and the YouGov poll, which came out the following morning, was pretty categorical, and that the public did not love the headline of higher taxes for in the future to pay for greater welfare spending today. That did not go down particularly well, and depending on exactly which measure you take, this was certainly on the YouGov's first leading question of whether this was a fair budget or not. This budget came out worse than every other budget they have ever polled on, other than the Liz Truss mini budget fiasco that we saw 3 years ago now. So a pretty rocky reception from the public in terms of their immediate response, and similarly, does this budget make you better off, worse off, or not much difference? Only 3% of people think it makes them better off. Remember, the Treasury's analysis suggests that maybe 30% of people should be better off by their calculations. So that's 10 times lower than the maths might suggest, you believe. And again, my earlier comments about in the first couple of years, actually this increase in spending is bigger in the first couple of years, whereas the tax rises are backdated. Maybe you might have thought that might have made people keener to respond to it in the near term. Absolutely not a chance of it, according to the public's first reaction. They haven't fallen for that particular trick, if you think that was a trick that was being pulled, and they're very much responding here that they've been told that their taxes are going up, and that makes them think that they're going to be worse off in future than they thought before. Why am I showing this data? It's not for political purposes. It's to try and get underneath the skin of the consumer psyche, because that is so vital for thinking about whether actually they are going to be prepared to open their purse strings a little bit and spend some of the financial firepower that we know they have, and generate a little bit of a confidence boost, virtuous circle through this budget aftermath. On this very early data, not much chance of that kicking into action, unfortunately. Final constituency to mention here is on business. I'm very interested in my colleagues' responses to this, of course, and keen to hear your own reactions for everyone who's joined the webinar. My sense from conversations I've had so far are that there wasn't a huge amount for business in here. There were some things which might be helpful around changes and rebalancing in business rates, but actually they might be offset by revaluation activity. But there wasn't a huge theme of this is how we're going to get growth going through this budget. And whilst there has been welcome protection for things like public sector investment, which is very important for infrastructure, there has been protection for I've forgotten the specific term for it, but the discounting, accelerating tax provisions around business investment. The reality is that it's not a real dial shift in the main, that for most of the businesses who've managed to draw through and understand exactly how this has impacted it. The final point I'll add is that in the kind of analyst community, commentators, there is a definite theme of this is and actually the kind of accountancy profession, this is a budget which has made several areas a lot more complicated. We've got new taxes on things like electric vehicles that we've never tried to tax on a per mile basis. We've got difficult changes to make to systems around salary sacrifice and our contributions to juggle with, and a whole host of other features. Mansion tax, again, a new tax, a new mechanism, a new lot of administration to have to pay for before any revenue actually comes in through the door. So for a budget which did put taxes up, we have taken choices to make it a more complicated kind of tax code rather than a simpler one, which is a continuation of a theme that the UK has been on for a very long while. So I will end my comments there and just briefly say thank you very much for your attention.
Thank you, Seb. Thank you, John, for joining us. For those who joined by Zoom, thank you. We will share the slides with you. Have a wonderful Christmas and New Year, and we will catch up with you in 2026. Thank you.